So in general, the way the tax system works is it's pay as you go, meaning that as you earn money, you're supposed to owe tax on it, pretty much the second you earn it. But they realize it's unrealistic for most people. And so what they've put together is a quarterly system because they want to simplify how much you actually owe. And so they also give you a few metrics. They're called safe harbors that you can track throughout the year so that you can avoid underpayment penalty. And so there's two general safe harbor rules. The first one is based on last year's tax, and the second is based on what you think this year's tax is going to be. And so I'll start with safe harbor 1 because this is the most common. This is effectively looking at last year, and it's calculated. There's one of two levels at which it's calculated. So if your adjusted gross income, this number here, is more than $150,000, then you have to pay in 110% of last year's tax. If it's under 150, then you only have to pay in 100%. So that's already the first nuance right there at the beginning. So in this case, adjusted gross income in this example is far more than 150,000, and so this person would need to pay in estimated tax payments 110% of their total tax from last year, for the first safe harbor. And so when you do the math, I used round numbers to keep it simple. So if you had $100,000 as your total tax, you need to pay in 110,000 throughout the year. Now, when is that due? The IRS has a quote quarterly payment system, and I use quarterly in quotations because it's not actually quarterly. You owe the first one in April; it's April 15th. You owe the second one in June, be June 15th, then September 15th, and then January 15th. Now, the justification for this is the IRS says that is more in line with most businesses' fiscal years and things of that nature of when income's actually received. What they won't tell you is that it's actually a byproduct of federal budgeting. And so the only time these rules change is when there's some kind of budget bill in Congress and they need to adjust the due dates to make the numbers work out for like deficit purposes. So I think the last time it was changed might have been the 1980s, and it was part of the budget process, for that reason. So anyway, I digress, but ultimately, that's when the payments are due. And then any remainder, right, if you don't pay in your full tax liability, you're going to owe that by April 15th, of the following year. And so if you follow Safe Harbor 1, basically you'd pay in $27,500 on the quarterly system here to get to the full Safe Harbor amount. But that's not your only option. The other option is Safe Harbor Threshold 2. And so the second Safe Harbor threshold is based on what you think this year's tax is going to be. And that is 90% of this year's tax. And so the same calculation would basically be 90% of this year's tax, which in this example is the same. So if you have the same amount of income, you can say, well, instead of paying in an extra $10,000 throughout the year that I don't need to pay in, I'm just going to pay in 90% of what I think this year will be and be, quote, safe harbored. And again, that has to happen evenly throughout the year. And so that alone can create a planning opportunity, because if your income's pretty stable, well, most CPAs and most off-the-shelf accounting software like TurboTax, when they give you estimated tax payment vouchers when you file your return in April, they're going to do it based on last year's tax because you haven't told them what you think this year's tax is going to be. But if your income is typically pretty stable and you're doing quarterly payments, well, why pay in $20,000 more throughout the year and get a $10,000 refund, especially knowing that although the IRS will charge you interest if you're late, they're not going to pay you interest if you pay in. And so for a lot of people, they want to pay as little as possible until they have to. So in these cases, like when your income's stable, we tend to recommend safe harbor option number 2, although there is a little bit of risk there, because your tax picture can change throughout the year. But let's assume it's stable. Well, then in that case, you'd pay in $90,000, and then you'd pay in the additional 10 when you file your return, by April 15th, and you're paid up, and you've paid in as little as possible, to hit the safe harbor, and you're exempt from underpayment penalties.